All right. Today is Monday, May 29th. This is a recap of the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. Happy Memorial Day. Of course, we salute and remember those who served in the past and those who serve our country in the present. In Kuwait, in Iraq, in Syria, in Japan, in the Philippines, Germany, Italy,
one eternity later,
Tanzania, and Ukraine. Wow. It's a long list. I think I went through every country in the world, but hopefully someday our troops will get to serve, America, St. Louis, Charlotte, Chicago. Hopefully someday. In the meantime, we got a lot to talk about. What a week it was, ladies and gentlemen. The AI mania took another level this week, and it was a painful week if you happen to be in the video short. It's like losing an arm. But you know what? You gotta be cheerful. Look at this Florida man, for example. He went to take a piss at a pond, and then the alligator came out and chopped his hands off. And he's being cheerful about it. He said it's not the end of the world, so long as the third arm is still intact. The one I was pissing with the head of the alligator with? Who cares about the left arm? And folks, I've been telling you since February of this year, you gotta preserve your ammo. You gotta preserve your ammo when the moment comes and you have to legitimately short. In the meantime, you want to take a swipe here and there, you got options. That's why they designed options, to limit your risk. But unfortunately, a lot of folks are short. They borrowed the shares. And now they're in deep trouble. But the good news is, while you lost one arm, the most important arm is still intact. And this is the one you're going to make a comeback with. I'll show you how and when we look at these charts and the indicators. But what is with this AI mania? It's overrated, it's a hype, and it's happening at exactly the wrong time. It's happening when the consumer is weakening, when the Fed is tightening, when recession indicators are flashing red, when inflation is still sticky and God knows how high it's going to go and whether it's going to come back and what the Fed is going to do about it. It must be changing the world. It can cancel everything, this AI. Well, I went back to AI and I asked the question, can you give me some quotes from the movie The Godfather? And it gave me some good ones, and then I'm reading some of them and they never happened in the movie. Look at this one, for example. It says Don Vito Corleone said in the movie, "Hey Michael, the world is a fine place and worth fighting for." Except that never happened in the movie. I mean, it sounds like the woke version of Don Vito Corleone, but it never took place in the movie. So AI is dumb as rocks right now. And this is what we're jerking off to. This is what we're losing our collective minds for. And you know what's really interesting about this AI mania? The bubble, now they're calling it a bubble officially. It's not done by the mom and pops. It's not the retail crowd. It's not you and I, the monkeys, hyping this shit. It's the institutionals. And those are the most dangerous bubbles. You know why? Because they can act stupid for a little while, but they also know what's up, and they know when to stop. And when to stop happens exactly when they're about to pass the baton of the mania, from the institutionals to the retail crowd. And that's the moment when they pull the rug and hand us the bags. And unfortunately, right now, I'm seeing a little bit of that this week. Of course, the retail mom and pops are being practical. In other words, when they see these hypes and these pops higher, they chase using call options. And call options, your risk is defined. Either you're going to get it or you don't get it, but your loss is limited. But they're not really buying into it. The question becomes, are we about to, giving the NVIDIA guidance, are we about to buy into this? And then they pull the rug on us and they say, oh, did we say $11 billion in revenue? Oops, we meant $9 billion. Sorry. But folks, we'll talk about this AI bubble in detail, the retail side, the institutional side in another video, because we got a lot of things to talk about here. What else is going on in the world? How about Elon Musk? Now he got the official stamp from the US government. Since we're talking about chips anyways, he now got the Neuralink chips that he wants to implant in your brains. They're ready to go. They got the approval. They're safe, just like the Moderna jabs. So any volunteers? Any of the culties going to go to Elon right now and say, hey, Mr. Musk, grab a chainsaw, have my head wide open, and put one of those chips in? Nobody? No volunteers?
I don't care.
Anyways, let's get right into it, folks, and we start with the Wall of Worry. Where else? DC, the circus, the fiasco. We finally got a deal. Now we have a few steps. The hardliners from each party, now they have to sell it to them. But for all intents and purposes, the deal is done. It's over. We don't have to talk about it anymore. Except, of course, to my surprise, because I thought the choices are either we default or somebody has to capitulate. And it's not going to be one-sided deal. Because if Biden capitulates, is he really going to do that? Is McCarthy going to capitulate alone? Doesn't make sense. Both have to capitulate and come to some sort of an agreement. And in any deal, if both sides feel a little bit screwed, that means it's a good deal. And my sentiment was, okay, we got it. Everybody feels a little bit screwed. They gave up a little bit of their demands, and that's it. That's a deal. But I'm surprised by the reaction from the Republican side, for example. They say now McCarthy caved and he should be removed. You got Wall Street Silver now says it's a horrible debt ceiling deal, and we have to vacate the speaker. Ted Cruz, he doesn't like it either. And I think everybody's mad because McCarthy caved on the IRS agents. Somehow he caved on the most important point, his party. So why did he do that? Let's read this piece and I'm going to translate it to you. It says, to win the speaker's gavel, McCarthy agreed to enable any single House member to call for a vote to unseat him, potentially making him vulnerable to ouster by disgruntled Republicans. The speaker said he was not at all concerned about that possibility. In other words, translation. McCarthy caved on the most important points, but he secured a closed-door deal with Biden and the Democrats that if it ever gets to a vote to oust him, the Democrats will side with McCarthy, and that makes it impossible to get him out. That's what it really means. So Joey B said, okay, I capitulate on a little bit of what you want. You capitulate on what I want, and I'll throw in a deal for you. A floaty, so you don't drown. If somebody from your party wants to take you out, I'll convince the Democrats to vote for you to stay. Boom. But the problem is, we have more voices now among the Republicans saying they don't like the deal. You got Congressman Chip Roy, for example, complained on Twitter on Sunday, said that the agreement would leave intact the expansion of tax collecting Internal Revenue Service set in place when Democrats controlled both chambers of Congress. And if this continues, they might tweak it a little bit. So they say, okay, did we say 87,000 new agents? We'll take them down to 47,000. And then you got another Republican senator, Lindsey Graham. He says that he expressed concerns not because of the IRS agents or because of America or anything domestic at all, but because of the effects on U.S. defense and Washington's support for Ukraine. So this treasonous clown is talking about Ukraine. These are your beloved and trusted leaders, by the way, that you guys keep voting for every single time, expecting different results. It's not going to happen. They don't work for you. They get their orders from the Pentagon and the intelligence apparatus up Uranus and the oligarchy. That's what it really boils down to. And by the way, both sides are screwed a little bit, and that's what a deal should look like. The Republicans are mad. What about the Democrats? We're seeing some dissent. Somebody like Steve Schmidt, for example, he didn't like some parts of the deal. That's how you know it is the best possible outcome. It doesn't address our debt problems in the long run. It just kicks the can down the road. But in the meantime, is it better than the default? I would say yes. Some would disagree with me and say, hey, we might take the hard pill right now, get a default so we can fix and get our stuff in order. I'm not a fan of that approach because there are severe consequences with that. You know what's going to get us in order with no default? It's inflation. If you think inflation is going to go down by its own just like this, you got another thing coming for you. This inflation will bring the whites of the eyes of these morons and will force them to have a balanced budget and be responsible with fiscal spending, because what we're doing right now is unsustainable. But that's as far as the dissent by the Democrats went. Even AOC, she's happy with the deal, and she calls herself a progressive. Let me tell you something about the Democratic Party. It's anything but democratic. It's a cult. And in a cult, you're obedient. You're supposed to follow the orders from above. You're not allowed to dissent. You're not allowed to independently think. And you're not allowed to criticize. So you might go on Twitter and have the impression that, oh, Biden won, McCarthy caved. On the contrary, both of them caved. But the Democrats, they follow whatever the leadership say. And if the leadership says, whoop, shh, shut your mouth, we won. It's over. Biden won. Get the memes out. And no dissent, no criticism allowed at all. So they're all going to come out and say, yeah, it was a great deal. Biden did not cave. But again, you look at the details, he did cave. But this is the sentiment that's going on. It might provide a little bit of a problem for this deal to pass. Maybe they have to tweak it a little bit, a little here, a little there. But for the market perspective, it's over. It's done. It doesn't mean that the market political concerns are over. Now we have to start thinking about the elections. And it appears that Biden has a major problem. At least according to the latest polls. You look at every poll, it appears that Trump is crushing him. 5 points, even DeSantis, up 4 points against Biden. If the economy indeed gets into a recession by 24, this is going to be a major problem. And the question becomes, are they going to pull the plug on Biden? And if they do, how will the stock market react to that? because that's the kind of volatility that we haven't seen before. You got a sitting president doing absolutely miserable at the polls, and there is a risk that he could lose. We've never seen before in recent history when either of the two parties pulled a sitting president out of the re-election ticket. We've never seen it before, at least recently. Then you look at the Democratic nomination itself, and this Kennedy guy is a major trouble because he continues to poll at 20% consistently. This is a major problem for Biden. I mean, we're talking about a sitting president who's polling at 60% within his own party. That's not a good number. But folks, I know you guys get emotional when you follow the politics. So my advice to you to keep your blood pressure down, look, they're both treasonous clowns. They don't work for us, and there is nothing we can do about it right now. So why bother? Why get emotional? We will deal with whatever they give us. Oh, you want Democrats now? Okay, we'll deal with that. Oh, Republicans today? Okay, we'll deal with that too. So here's what we have to deal with. We know that the debt ceiling has been lifted, at least on paper right now. So what is that going to do? All the hedges, the CDS, credit default swaps that people were buying, now they're going to come down crashing. Most of you are not trading these markets, so there's nothing to see here. But then we'll look at yields. Why did yields rise higher in the last, let's say, 2 weeks or so? Sure, part of it is we're seeing regional banks stabilizing a little bit. Sure, part of it is inflation is sticking and moving higher in certain categories, and maybe the Fed will have to do more. But a huge part of the move in yields in the last 2 weeks happened because insurance. In other words, yields are going to pay you more ahead of a default or a deal. Now that we have a deal, yields should pull back. The insurance part of the surge in the last 2 weeks should be pulled out. We should see yields moving down a little bit. And if that is the case, doesn't that open opportunities for us? At least trading opportunities? The answer is absolutely. So let's talk about that. And here it is. If a huge part of the move in yields and the dollar index lately was due to insurance, then we should see pullbacks in these two. And by the way, remember when I told you buy the 1 month, stick some money in the 1 month, 3 month, 1 year, and 2 year? They're paying you really good yields. Now the 1 month, that's over, because it was paying you about 5.5, 5.6. At some point, it paid 6%. A lot of you, the Top Gun members, Mavericks, who talked to me in the phone and said, hey, what do I do with the portfolio? I said, stick some money in the 1 month because it's paying 6% right now, 5.5. But that's going to go down at some point. And my expectations are you'll see all of this insurance going down now that we have a deal. The good news is you're still going to have elevated yields in the 1 and 2 years. I would say stick some money in there. 1 year pays you 5%, and then maybe next year, if the equities market crashes and bottoms, a legitimate bottom this time around, then you can switch back to equities. At the same time, you leave about 20% of your portfolio, depending on your age, of course. That's your money to trade, to invest, to chase the AI mania, to short, to do whatever you want to do. But 80% of the portfolio should be in these treasuries, paying you 5%, 5% plus money market funds. Do something, because I look at your portfolios, and they're all good portfolios, but they're good if the year was 2017, not 2023. And I know somebody who's 22 years old right now is going to say, hey, Maverick, but I went all in NVIDIA and I'm up 120 million%. Yeah, you're still in your diapers. Go back, your mom is calling you. The year is not over yet. But all joking aside, believe it or not, the people who are doing mania right now, who are chasing manias and gambling like never before, they're not the 22 years old. Those guys are actually becoming really conservative. They're the ones buying treasuries and buying money market funds. You know who's gambling right now in an insane way like never seen before? Is guys in their 40s. And when I read these articles and talk to these guys, somehow they don't remember 2008. They don't remember the GFC and let's say the 2006 to 2008 before the crash. I'm like, were you guys like 2 years old back then? Really? You guys don't remember anything at all? Is it memory loss? What's going on here? Because we got guys in the 40s, midlife crisis, who knows? Hormones are flowing in your body like crazy right now. All of a sudden, you're feeling like a teenager. You'd anything that has feet. And what they're doing in the stock market right now is a reflection of that. They're going insane, gambling hundreds of thousands of dollars on weekly options, on 0-day till expiration options. I've never seen this before. But anyhow, back to the point. When you look at portfolios here in real life, not in Robinhood, folks have diversified portfolios. And when I look at them, okay, the Apples are up 30%. The Amazons are up 30%. But then you got your Schwab down 40%. Your oils are down. Your industrials are down. And all in all, the S&P doing 9% for the year. That's with the AI mania. But you're doing 3 to 4%, which is the best you're going to do this year. Because when the AI mania goes down, your portfolio will be down 8-9%, if not even more. So why not stick the money in a treasury fund? You get the 5.5%, and then leave about 20% of your portfolio depending on your age. You can leave 15, 10, 5, depending on your age. That's your trading and your stock market speculation money. So you don't feel like you're missing out right now. And then we see what happens next year. But anyhow, you look at the 2-year yield, for example. This is the daily chart. We're getting to overbought territory. We closed the gap, and now we have a deal. The insurance part of this rise higher in the last few weeks should be trimmed down. But this is really important, so pay attention now. You look at the weekly chart. It appears right now that this thing is about to make a higher high if you look at the RSI and the MACD. In other words, for now, the assumption should be that any pullback in yields will be transitory. This is really important. And then we'll look at the dollar index, for example. Here's the 4 hours chart. It is in negative divergence. It is way overbought. A lot of the move that we've seen in the last few weeks is due to insurance because of the default. Now that we have a deal, it should pull back. Let's say to 103, maybe 102.5, who knows? But we have a pullback in the dollar. Yet you look at the weekly chart, it appears that we have a double bottom. Look at the MACD indicator, it's already in the green, it's already bullish. So whatever pullback we get in the dollar, it's going to be transitory. In other words, what I'm giving you right now is trading ideas based on yields and the dollar going down in a pullback. Now, the biggest criticism I've been getting this year is, what happened to you, Maverick? You used to talk about investing all the time. Now all you talk about is trading and options. My rebuttal is, what is your investing idea? What do you want to buy? You really want to spend $700,000 buying healthcare or technology or whatever stock you want to buy? Because notice what happened this year so far. It has been thematic. One week we have one theme, the other week we have another one. Healthcare was hot for 5 minutes, then it was not hot anymore. Defensives were hot for a minute, then they're not hot anymore. Gold was hot for a little bit, not hot anymore. Utilities, real estate, banks, I can keep going. The only consistent theme this year has been the AI mania. You want to chase the hype? Be my guest, if that's your investing idea. But don't come back to me crying when these things come down crashing, because they come down crashing really fast and really hard, and you're not going to have time to get out. The way I look at hypes is, okay, nice to look at. I'll take a swipe here and there via put options and see what happens. But then when they start to go down, I short them and make money that way. In the meantime, it has been a horrible year for investors. You take the AI mania away and the market is either flat or down. So again, for my investor friends, the only thing you can do right now is stick your money, get the 5 and a 5.5% risk-free, and then have a little bit of money to play the stock market. That's all I can tell you right now. Because it is a trader's market. Sometimes we have an investment market, sometimes we have a trader's market. This year so far, it has been a trader's market. Anyhow, if we see yields going down, if we see the dollar going down for a little bit, in the last few weeks, which names have been getting punished horribly while yields and the dollar have been rising higher? The answer is yields and dollar-sensitive names. Wow. What a revelation. But it is true. Here's a chart, for example, a daily chart for the ticker DUK, Duke Energy. It has been getting hammered in the last few weeks. Really oversold in the RSI, really oversold in the Bollinger Bands, oversold in any metric you can look at. And the reason is, it is a high dividend paying name. And if you have the risk-free rate paying you 5.5%, do you really want to take a shot and buy utilities for what? 3.5%, 4% yield or dividend? Doesn't look good, does it? But now that yields are about to pull back a little bit, can we see some of these oversold conditions playing out in these names, like Duke Energy, for example? That's my bet. But just like I showed you, the dollar is bullish long run, so is the 2-year. We look at the weekly chart for Duke, doesn't look good. So again, all of these are trading ideas. And I shared some of these ideas with you on Friday on Discord, on my morning brief. But we'll go over them again just to hammer the point. The same goes for the XLU, daily chart, really oversold, due for a pop, due for a rebound. You look at high dividend paying names such as AT&T, I gave you this name on Friday on the morning brief. We got a little bit of a rebound on Friday, still oversold, maybe it goes higher to close the gap. It is a trading opportunity. You look at Verizon, same thing, oversold. Could it close the gap in a rebound? Sure it can. The XLP, consumer staples, we talked about this on Friday, oversold, got a pop. Can it close the gap? Yes, it can. XLP, consumer defensives, pays really good dividend. A lot of high dividend paying names. but they're not attractive when the risk-free rate goes higher. Now the risk-free rate is about to take a dip, a pullback, which will make these names a little bit more attractive, at least from a trading perspective. AbbVie, the ticker ABBV, that's another high dividend-paying name. Really oversold, due for a rebound. Maybe it closes the gap above. Not the big one, but the small one, the most immediate one. I view this as a trading opportunity. Now, what happens when the dollar goes up? Because of insurance, because of default, because of whatever. Dollar-sensitive names go down. And then when the dollar pulls back, we see these same names catching a rebound, which opens trading opportunities. One of the most sensitive names to the dollar is metals, the XME. That's oversold right now. If the dollar pulls back, we could see a pop in this name. But again, it is tradable. It's not investable. Here's another one, NEM, New Mount Gold. We've been watching this chart for a little while. It is really oversold right now. It pays dividends, I believe, on Wednesday. That could be a bad day, but maybe after that it starts to rebound and close some of these gaps above. And that will happen especially if the dollar pulls back. Another one is Nike. Not a strong case, to be honest with you. It is oversold, but it is a huge multinational company with a lot of revenue coming from overseas. Now, we know why Nike is going down, a lot of problems with China. But if the dollar eases, wouldn't that be good for Nike's revenues? At least from a trading perspective, the answer is yes. So we could see an oversold bounce here. Folks, you get the idea. Now, the most popular question. After the AI mania and the pop in NVIDIA last week, the most popular question is, Maverick, is it time to short the NASDAQ? Is it time to short chips? Like I said a million times before, you want to buy some put options and take a stab at these charts and hope you're going to get lucky and it's going to be the time exactly when they go down? Sure. Go ahead. Your risk is limited. This is the price you're going to pay for the put options. If it works, it works. If it doesn't, you're going to lose the premium, and that's it. But if you're going to go short and you borrow shares, or what I call shorting with both hands, which could also mean put options, but let's say $100,000 plus spent on these put options. I'm not going to do that until three conditions are met. And I shared with you this before, and I'm going to share it with you again. Number one, fundamental reversal. What does that mean? Either the tailwind is exposed as fake. In this case, in the AI mania, NVIDIA comes out and says, whoops, did we say 11 billion? We're going to be at 7 billion still? Or we see a development of a headwind that overshadows the tailwind. That could be coming from the Fed policy. That could be coming from the consumer side. That could be from the systemic risk side. It could be political. It could be whatever. Because, ladies and gentlemen, at the end of the day, what moves markets is three things: fundamentals, technicals, and mechanics. And you have to get confirmation from all three before you go short with both hands. When we talk about a technical reversal, what do I mean by that? I mean extended weekly, not daily, weekly RSIs, plus a reversal candle on the weekly chart. Let's look at the NASDAQ, the NDX. This is the big NASDAQ NDX 100. You look at the daily chart, sure, it is overbought, which means you can take a stab at it. You can buy some put options right now. There's no guarantee they're going to work, but your risk is defined and limited. Yet when you switch to the weekly chart, is it really that overbought? We have seen the NASDAQ getting really overbought before it pulls back. The NASDAQ loves to get really hot before it pulls back, which means, again, this is crazy, but if it wants to get really hot, it could go all the way to 15,265.42, which is right about the top of the shoulder. Now, if it gets there in one shot really fast, and I see the RSI becoming really overextended, then for sure, I'm going to be shorting with both hands. Feet might be involved too. And if you know anything about me, you know that my feet is really wide. It's big. So it's not going to get involved until it's really serious. Now, what about chips? A lot of you love to look at the SMH, and we're going to look at that in a minute, but I also like to look at the SOX, the Philadelphia Semiconductor Index. And the reason is it's older and it's, let's say, more accurate. The distribution of weight is more, let's say, not tilted toward NVIDIA AMD. It's more inclusive is what I'm trying to say. We look at the daily chart, sure, it is really overbought. You want to take a swipe at it and buy some put options, have at it. The risk versus reward says you could be right. We could pull back right away. But then we'll look at the weekly chart for the SOX. Is it really that overbought? The answer is not quite. We have seen it more oversold in the past. Maybe it has a little bit more juice to squeeze now that the clients are crying to their managers and saying, get me in NVIDIA, get me in AMD, get me in anything AI. Of course, they're buying at the top. These are the morons who are going to end up holding the bag. So we can go all the way to 3,633.14, and then it becomes really overbought on the weekly, and then I'll be shorting with both hands. Lastly, in the Maverick conditions to short with both hands, what about a mechanical reversal? It means extreme call options positioning, which is kind of happening right now. And when I start to see big, unusual short bets, we have a big one in the queues, really big one. So a leading indicator, sure. Are we getting close? Sure. When we look at the put to call options ratio, you see when it gets above 1, specifically if it gets to 1.10, that is a safe point to close your shorts and start buying. When we go down to, let's say, 0.8, which we're getting close to, that is a sure bet for you to short. Book profits from the longs and start shorting. Now, this data is May 26th, so it's going to be updated, let's say, tomorrow. And we might include some data from Friday, which was a lot of call options buying. So we might get to 0.8 by Tuesday, Wednesday. So as you can see, folks, we're getting close, but we're not there yet to place the big shorts and play the swing trades. A lot of you are swing traders. When do we swing Maverick? I don't know. Ask your wife. But in reality, you gotta ask the weekly RSI. And the weekly RSIs are getting there, but they need a little more work, a little more of the mania that we've seen last week. And we're gonna get there. And we're gonna play it together. In the meantime, use these trading ideas, see what you like, what you don't like, whether you agree with me or not agree with me, and trade something if you like. Anyhow, let's talk about macro. You know that we got the bullish camp, and the bullish camp is divided between soft landing and a pivot. And then you got the bearish camp, which is divided between stagflation and a recession. I happen to be in the stagflation camp. So let's see the slew of economic data that we got this week, and let's see which side is winning so far. We got inflation PCE on Friday, and the headline reads, U.S. inflation picks up, keeping the Fed tilted toward another hike. Whoops. And the specifics here it is, 4.4% year on year versus the 4.3 estimate and then 4.2 in the prior month. So inflation is moving higher again. And this was predictable, by the way. We talked about this a million times before. All you have to look at the prices paid in the manufacturing and services PMIs. They'll tell you exactly what's going to happen to the CPI. And the PCE in this case. The core PCE 4.7%, 4.6 the estimate, and 4.6 the prior reading. But here's the problem when you dig into the details, and this is coming from Nick Timoros, aka the Fed Whisperer. I don't know why they call him the Fed Whisperer. I got my sources in the Fed too. The Fed is like Gossip Girl. There's gossiping happening all over the place. You can find your Gossip Girl all over the Fed. Somebody's going to talk to you. So I don't know why they call him the Fed Whisperer. He has his sources within the Fed who leak things to him. I got my sources, they leak things to me. How come I'm not called the Fed Whisperer? But anyways, he says the core PCE services including housing, a widely watched measure because it strips out goods which are slowing, and shelter expected to slow, rose 0.42% in April. On a 3-month annualized basis, core non-housing services 4.4%, core goods 2.1%, shelter 7.2%. What he's saying, in other words, it's not good enough for the Fed to pause. That's what his source is telling him. Not enough for the Fed to pause. 25 basis points coming. And here's the zombie from San Francisco Daily. She says, I want to see ongoing slowing in super core inflation. Okay. Did you see the SVB collapse too? Because that happened right under your watch, Mrs. Daly. And then Bloomberg says, oh, we got Team Worried, aka the Hawks. Then we got Team Pause, aka the Doves. And then we have Team We Don't Know. And I say, how about we pull all of these names together and put them in the Team We Don't Know? Because they have no f***ing clue what they're talking about. All they say over and over and over again, we're data dependent, which means we're not in charge and we refuse to be in charge. We're going to let inflation do its thing and we're just going to keep following. Inflation goes down, we ease it down, and we start talking about, oh, maybe we're getting closer to a pause. Next thing inflation says, hold my beer. Comes PCE inflation, says, f*** all of you, I'm coming back. And now the Fed, did we say we're going to pause? We're going to do 25, I guess. This is a dangerous game. They have to be in charge. They have to have a guidance. They have to be proactive, not reactive. But folks, we've been saying this for years now. They're never going to listen. There's nothing we can do here. And look at the odds. The odds were about 40 to 60%. And then Jerome Powell came out with the paper, shaking, twitching, drooling all over the place. And he took it down to 13% on the orders of Janet Yellen. But he was a total jerk off. It did not work out because now the odds are back at 60. Now, 25 basis points is in the bag. So if Jerome Powell is worried about blowing something up, it's going to blow up. because you got the cover from the AI mania, you got the cover from the bond market, and now you got the cover from the odds. You gotta do the 25. If you don't do the 25, it's gonna look really, really suspicious. It's gonna freak out the market because we're all gonna ask, what are they afraid of? What are they seeing that they have to pause, even though the bond market giving them the green light along with the stock market and along with the odds? Something doesn't add up here. We look at durable goods. It says, got a boost from military spending. Notice that the Republican Party will never, ever cut military spending, aka the landromat. The actual landromat is the Pentagon. We give them trillions of dollars a year and we don't see the receipts. No auditing allowed, nothing. Here's the check. Do whatever you see fit with it. You want to gamble in the stock market with $1 trillion? Go ahead. You want to buy a bunch of mansions? Go ahead. You want to use the money for bribes overseas to dictators? Go ahead. And that's why, ladies and gentlemen, LMT, Lockheed Martin. But the devil is always in the details, folks. And when we look at the details, here it is. What has kept the economy afloat is an increase in spending on services such as travel, recreation, and hospitality. Well, that's going to slow down. Just give it a little time. This will be the last summer season for that kind of spending. I'll show you the data in a minute, but looking ahead, durable goods spending will continue to get a lift from pent-up demand on autos or for autos. What does that say? More and more inflation is in the pipelines. More and more auto inflation is coming. Do you really think this is over? Because we're just starting here. We're just warming up. What you saw in 2020 is absolutely nothing. What you're about to see will shock you for the rest of your life. What about consumer spending? Because we got that on Friday too, and it says consumer spending is far from dead as Americans had cash registers ringing in April. Wow, we're all rich, folks. We all got a lot of money here. Households spend more on cars, drugs, a lot of money on drugs, trust me, and financial services. You're not going to need that anymore because who needs financial services anymore? You got ChatGPT and all you have to do is put your blindfolds on and buy AI. Anybody who says AI, roll the dice. But again, folks, the devil is always in the details. And it says U.S. savings rate fell for the first time since last year to 4.1 from 4.5. Wow. Savings had fallen in 22 to the lowest level since 2005. So we know we're living on borrowed time. We're whistling past the graveyard. The consumer is about to run out of cash, and certain segments of the consumer have already ran out of cash. When a lot of you ask me, hey Maverick, the data is really confusing. You say that the American consumer is collapsing. We see spending going down. We see debt accumulating, rising rates, etc., etc. But at the same time, we see a lot of stampeding happening in the housing market, for example. On autos, there is a reason for that. When it comes to housing and autos, there is a shortage. We know all about that. But the recession force doesn't hit the economy equally. We're living in an unequal economy. You talk to the poor and the lower middle class, they're getting annihilated. They're already annihilated. Now the recession force is kind of hitting the middle class. Now they're feeling the pinch a little bit. And then you got the upper middle class, the tech worker class. They lost their jobs. Sure, they have a lot of savings. They have a lot of generous severance packages, but they're going to run out of cash too. And of course, you have the top end, the highest consumer, the rich. They tend to be economically savvy. And when they start to see bad signs happening in the economy, they start to pull back. And they are pulling back. And you see that evident with luxury stocks. They've been hot for a long time, beating the market by far. But all of them came down crashing in the last 2 weeks because the affluent consumer is pulling back. And the majority of spending that is happening right now is limited to the middle class. But the recession force is about to sandwich them. For example, when we look at debit and credit card spending, it's actually going down. So when they say, what about the AI mania, Maverick? I say, you think the AI mania is going to cancel the consumer? Who's going to stimulate the economy if the consumer is running out of cash? Who's going to stimulate the economy if the consumers start to lose their jobs? AI? When I'm asked these days, does the AI mania makes you want to capitulate, for example, and become bullish again? Do you feel that your thesis is not so strong as it used to, let's say 2 or 3 months ago? My answer is, the AI mania actually makes me more bearish. Because it scares me more. The economic bomb that will land on our heads is now loaded with more explosives. And these explosives happen to be in the largest companies in the world. If they get engaged in a hype, a bubble cycle, a boom and bust that could happen within months, not years, what do you think will happen when the weight of these largest companies of the world come down crashing on our heads, along with everything we've been talking about for over a year now. The accumulation of debt, subprime auto loans, zombie companies, regional banks, commercial real estate. This is going to be the biggest bomb of them all. The GFC bomb was limited to banks and housing. The rest was okay. Now we have everything about to crash in our heads. You're supposed to be more terrified that this kind of reckless behavior is happening at this stage and this cycle of the economy. Not thrilled. But folks, some of us have to learn the hard way. It is what it is. So in summary, once again, we're going to look at the data. Who scored points this week? It is certainly Team Soft Landing. They have the AI mania, and they can use consumer spending to their advantage. That despite higher rates and whatever the Fed will hike in the next meeting, the consumer remains resilient. So Soft Landing gets a point this week. What about Team Pivot? Team Pivot is a bunch of clowns anyways, so they got nothing. There's nothing that says the Fed is going to pivot, so we're going to give them 0. Then you look at Team Stagflation among the bears. Sure, we got a lot of points this week. PC inflation is going higher. Consumer spending is inflationary. The AI mania loosens financial conditions and allows inflation to go higher. In the meantime, we continue to see weakness among many segments of the consumer. We even see the same weakness happening in China. Now, when we look at Team Recession, they're going to be right at the end, but today, this week, they gained nothing at all. They lost a bunch of points. Inflation's still moving higher. Consumer spending is still hot, at least within certain segments. So for now, the battle remains Team Soft Landing versus Team Stagflation. Choose your fighter, folks. You want to be in Team Jim Cramer and Tom Lee, or do you want to be in Team somebody like Muhammad Al-Arian, for example? It's up to you. Now, let's talk about the indicators, and this is really important. Whether we are in a bull market or not, we have to look at the indicators one by one to see whether we're really in a bull market or a bear market, but we have a mania that's going on within a bear market. The indicators we look at is the NDX, NASDAQ, then we look at the SMH, chips, and then we look at the XLY, consumer discretionary, we look at the XRT, retail, the breadth of the market, and divergences. And then we see whether they're bullish or bearish. We look at the NDX, the monthly chart. Look at the MACD, that's what's really important. Do we have a crossing and a confirmation that it is bullish? The answer is we have it now, but we have 2 days left for the month. Anything could happen, but a closing like this right now is a confirmation that the NASDAQ is bullish. So we'll give this a check mark for bullish. We look at the SMH chips. What do we see here? I was concerned that chips were sending a warning signal that the rally in the NASDAQ and the big caps is not real because we have a lot of weak actual data coming from semiconductors. Then came the AI mania, disregarding all of these facts. And now we have a massive pop on the monthly candle. You look at the MACD indicator, we have a confirmation, at least for now. We have 2 days left, anything could happen. But for now, the SMH chips is bullish. So we'll give a check mark for this one. Then we look at the XLY, which is another indicator for the consumer, but the ETF is heavily influenced by Amazon and Tesla. Of course, Booking and Chipotle, few names that really should be taken out so you can see the clear picture. But again, even with Amazon and Tesla, you look at the XLY in orange, you look at the Qs in white, they trade hand in hand, historically speaking. Now we have a divergence. QQQ moving higher, XLY staying where it is. And then thank you to all of you who messaged me on Twitter, Discord, email, YouTube comments, everything. A lot of you contributed and told me how to do the XLY minus Amazon minus Tesla. Some of you even went as far as doing a redistribution. And they say, look, Booking and CMG, Chipotle, have a bigger weighting and influence right now in the XLY than Amazon, Tesla. You take all 4, Amazon, Tesla, Chipotle, and Booking, and then you redistribute the weight, and the XLY is actually never recovered from the pandemic crash. But if we just do it like it is, just take away Amazon, Tesla, no redistribution of weight whatsoever. XLY in orange, XLY minus Amazon in white, XLY minus Tesla in blue, and then XLY minus Amazon and Tesla in yellow. And you can see that the XLY without these 2 names is up only 4% for the year versus the 17.5 plus that the XLY is up for this year. In other words, it's a lot worse than what the actual chart of the XLY says. So we'll give a check mark for the bears on this one, because if you have a legitimate bull market rally, if you have a real economic recovery and a soft landing, then the consumer should be leading all of this, and the XLY should be leading, not lagging. And the same goes for the XRT retail. If the consumer is healthy and strong and we have an economic recovery and a soft landing and the beginning of a new bull run, it should be led by the XRT. When we do that, look at this. Unbelievable. The Qs shooting up higher, XRT crashing. So we'll put this in the bearish camp, and then we look at the breadth. It's absolutely awful. Year to date, We only have information technology, communication services, aka Google Meta, and then consumer discretionary, which is the XLY. But again, you take Amazon and Tesla out of it, it doesn't look pretty good. But you look at all of this, we only have 3 sectors in the green. The rest of the market is going down. Energy down 10%, utilities down 9%, financials down 6.5%. So is healthcare, real estate down almost 4%, metals down 2%, staples down 2%. This is not a bull market, folks. If anything, this is a bullshit market. Look at this. In blue, we have communication services. That's up for the year. You got the XLK technology in brown, I guess. That's also up. And then you got the XLY also up due to Amazon, Tesla. But the rest of the market is either flat or down. Again, is this really a bull market? It's not. And again, we're going to have the inexperienced player who's going to come out to me and say, but Maverick, it's different this time. Embrace the future, not the past. And I say, how about you take your blindfolds off? There's no such thing as it's different this time. They said it's different this time in 21. They said it's different this time back before the GFC. They said it's different this time during the dot-com bubble. They said it's different this time during every hype and every bubble. It was not different. They all came down crashing. And this is perhaps one of the most dangerous bubbles ever. It's happening amidst a bear market, and it's happening amidst some of the worst financial and economic conditions we've seen. So when we look at the breadth, we give this as a point for the bears. Then we look at divergences. Here it is again. NASDAQ up 24% for the year. S&P up 9.5%. Thank you to the big caps, of course. Dow Jones flattish. It's actually negative. IWM also negative. Is this what a bull market looks like? Or is this what a mania bubble within a bear market looks like? Look at the divergence between the IYT transportation and the Qs. They usually trade hand in hand. Now we see the IYT stalling and moving down, Qs moving higher. We plug in the S&P, similar story. The IYT supposed to be leading, at least trading hand in hand with these indices. It's not. We look at the Qs in white and then copper in orange. Same divergence. It's not supposed to be this way. They're supposed to be trading hand in hand if this is indeed a bull market. We'll look at the Qs versus the HYG. Qs in white, HYG in orange. It's supposed to be trading hand in hand. They're not. Then we'll look at the 2-year yield in white and the Qs in orange this time around. And to summarize this, every time we see a positive divergence in the 2-year, we see a negative divergence in the Qs. In other words, a rise in the 2-year is bad for the Qs. Now all of a sudden, we see them rising higher together. So something doesn't add up here. Then we have another one that I shared with you before, the leveraged loan index from Morningstar. Every time we see it bottoming and moving higher, you want to buy the stock market. Every time you see it topping and moving down, you want to sell/short the stock market. And this has been a spot-on, accurate indicator. What does it say right now? Here it is, and once again, in Jan 22, it was rolling over. That was a sell signal. At around July 22, it was bottoming. It gave us a buy signal. That was the summer rally, the bear market rally. Then in August, it gave us a sell signal by rolling down. So you were supposed to get out of the market. And if you did pretty good. And then in October of last year, we saw this chart bottoming and moving higher again. That was the buy signal, the October bottom. And then February of this year, when we got the inflation readings, it started to roll over and move down. That was the sell signal. And the market went down. Then it bottomed and it moved higher again. During what? The SVB collapse. And that was your buy signal in the stock market. Now it appears that it is rolling over a little bit. In other words, it's given us the sell signal. Not quite sure yet, but you see where the Qs is trading versus this one? And we have yet another divergence. The leveraged loan index is kind of rolling over while the Qs is shooting up higher. So we'll give this to the bear camp all in all. Still no bull market. What we have is a bubble within a bear market. That's all there is. And the bubble happens to be in the largest names. And therefore, we see the distortions on the charts, the index charts, the S&P, the Qs. You get the story. But for you to fall into this and say that this is a bull market and you start chasing the mania, you're falling into the dumbest bull trap in the history of the stock market. Absent of these indicators improving and we see a rotation out of the AI mania into the cyclical side of the stock market, absent of seeing inflation actually moving down and the Fed having to back off, you can't say that this is the bottom. You can't say that this is a bull market. And if you do, you're going to learn the hard way. I promise you. You're going to look back and say, oh my God, the inversion of the yield curve. Oh my God, that was not lying. Oh, the manufacturing PMIs crashing before a recession. Oh, that was not lying. Oh, households net worth crashing. Oh, that was not lying. The M2 money supply crashing. Oh, that was not lying. Oh, yes. Oh my God, how could I not see that? But it's the market's job to make everybody look foolish. In the beginning of the year, everybody was bearish. Everybody and their mothers. If the market crashed back then and we got a recession right away, that everybody would have looked like a genius. But the market wants to make everybody in that camp looks like a clown and make who looks like a superstar. The guys who've been getting slaughtered last year. And now they're kind of looking pretty good. Tom Lee looking pretty good. Jim Cramer looking pretty good. The 20-year-old trader is looking pretty good. And who's looking like a clown? The Maverick Wall Street looking like a clown. Mike Wilson looking like a clown. All the bears looking like clowns. And a lot of them are now capitulating. All the fake YouTubers who've been bullish, saying that inflation is transitory and we're going to go to the moon, and they changed to bearish all of a sudden, they have to be washed out. They have to capitulate. And once they do, and we start to see vanity developing in the bullish side, and they start to become more bold and more cocky, and the bearish camp looks weak, a lot of people left, everybody in the bear camp is ridiculed and looked like as, okay, these people are crazy. They're still stuck in 22. Then they pull the rug on you. This is the nature of the market. It doesn't want to pay everybody. The house always wins. It's not going to reward the most people at the same time. When it crashes, not everybody's going to look like a genius because a lot of people capitulated. It's only the people who stayed in that camp and stuck to their theory and stuck to the facts and the data, they get rewarded. And the people who feel smart today because NVIDIA and the AI mania is going bananas, they look stupid when it happens. How could you guys chase this when every indicator was telling you a recession is coming? That the Fed will have to raise rates so much to take this sticky inflation out of the economy. And the end result of that is a recession. And the market will crash like you've never seen before. But that's the beauty of the stock market. It wants to make people look like fools, the majority at least. And then at the end of the day, it only wants to pay the least amount of people. It always happened that way. And with that, folks, since this is a really long video already, we're going to wrap it up right here. We're going to get this part of the video to you as soon as possible. And then I'll do the technical analysis, the options market, what's going on. It's really interesting. The stuff we're seeing in the options market is really telling. The stuff from the charts is really telling. But that's going to be part number 2. It's going to be a separate video coming out later this evening. If you don't catch it right now, you're going to catch it in the morning. And by the way, I'm going to be off tomorrow, but you're only going to get 2 videos from me. If you happen to be a member of the channel, you're going to get the picture reviews, and you're going to get some portfolio reviews from the Top Gun Maverick members. We'll look at their portfolios. I'll do a review, look at them one by one, give my 2 cents, and everybody learns that way. But until then, folks, this is all I got for you for this video. Thank you for listening. Thank you for watching. And I will talk to you again soon. Stay tuned.
Flying to financial analysts, our new profitability plan.
What do you want? More inflated guidance so we can underperform in all 4 quarters again next year?